Sticky inflation, rising deficits, and an uncertain labor market are continually reshaping the investment landscape. Is the Fed's balancing act enough? Are bigger risks looming? We'll find out what matters most and where to find opportunity in this episode of UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thanks so much for joining us today. My guest in the studio is David Bianco, DWS America's CIO. David, nice to have you here. Good to see you.
Anthony, great to be back. Thank you.
Inflation has certainly been pretty sticky, very range-bound for the last year. I think we've gone from, if you look at the month-over-month percentages, unchanged March 2026 to just a rise of 0.3% in February's reading. It's interesting when you look at that CPI number, and the divergence for investors has been really kind of head spinning. Obviously, there's a lot of volatility going on, which we'll get to. I just want to kind of get your sense on the Fed. They left rates unchanged at the most recent meeting. We expect here at UBS and our chief investment office that they are going to cut at some point this year, possibly 2 times. What are your thoughts on the direction of the Fed, given where we know inflation has been? Kevin Warsh may be coming in,
Right.
Powell is going out. A lot going on there.
Right, sticky inflation, still very close to 3%, not the 2% target, very high deficits, and a slowing jobs market, certainly slow hiring, not too much firing. But this is a very difficult macro environment for any central bank, the Federal Reserve. And that's part of the reason why it's an uncertain environment for investors as well, which we'll talk about how to navigate. At DWS, we're still in print for a couple of cuts by the end of the year, but obviously new developments in the world, the conflict, higher oil prices. But it's not just high oil prices. There's a lot of uncertainty around what neutral, or even I'm going to use the word natural, interest rates are for the rest of this cycle. Inflation's been above the Fed's target, clearly so, on every core measure for a handful of years. That's a bit too long, and it looks like it's going to stay above that target for longer.
Right. I think we're sitting around 2.4% inflation. The Fed's target, as we know, is 2%. I mean, just about. And it's consistently shifting, obviously, for various reasons. As you said, the Iran conflict, we're seeing a lot of volatility within oil prices and the markets in general. Markets are pricing in fewer rate cuts this year. Do you expect that markets will continue to kind of follow that path,
right,
given what we know and a lot of course, more importantly, the uncertainty that's ahead of us?
Okay, so my view, and I'm continuing to talk to my colleagues about this, is that the Fed's likely on a long hold. It's possible that there's a cut by the end of the year, but I think a long hold is also a pretty constructive outlook, that the economy doesn't deteriorate so much that the Fed needs to cut, because I think the Fed needs to start thinking very carefully about waiting to take decisive action until it's needed. And I'm not sure a 1 or 2 cut is going to do really anything to help the labor market. And in my view, the labor market's slowing, and some of the further challenges ahead, perhaps AI disruptions, these are secular trends that will play out over time, and I don't think the overnight rate affects that. So I believe that the Fed should wait until action is necessary to cut. And then, as I said, I'm also of the view that the conflict is not going to be so bad or so long-lasting that we're looking at something along the lines of $200 oil toward the end of the year, which may require the Fed to hike. I don't think that happens, and I do think it takes a lot to get the Fed to hike. I wouldn't suggest they do that, but we have inflation well above their target for too long now.
Yeah, I mean, it is the sort of dilemma that the Fed is facing. It's you have to either cut rates to support growth or keep them higher to tame inflation. So, but thanks for providing that feedback, David. And as I said, as of right now, our view still here is to maybe get 2 rate cuts. Yeah, but obviously everything is shifting, and kind of you have to follow the path of the headlines and what's going on. And even when you're looking at deficits, they're running at around 6.6% of GDP. So that's historically very high. What are your thoughts on that?
It's too high.
Yeah.
I mean, it's normal to have deficits. You want your deficits to be more in line with GDP growth, nominal GDP growth, but you want inflation about 2%, and maybe the U.S. economy is doing 2.5% real GDP growth. So it'd be better to get the deficit down to 4.5%, especially because we're not in a recession, and you do want the capacity to respond with fiscal response, higher deficits during a recession. So this is too high for a non-recession environment. The sticky inflation, we know that conflict is inflationary, and we know that conflict can be very expensive. This is why I think it's really key to focus on the 10-year yield and not overly obsess about what the Fed does or should be doing, because the 10-year yield is really what's going to influence the economy more, housing, long-term debt sustainability of U.S. Debt. So I'm keeping an eye on the 10-year yield, and this morning we've seen the 10-year yield 4.4%. The 10-year yield has gone up as the equity market has sold off on this conflict. That is something that we've seen too many times now, that the Fed cuts and yields go up, or lately in the past years in this recent event, equity market or threats to growth, and yet the 10-year yield goes up. I think that's a signal of being very careful in the next Fed actions.
Yeah, because the yield curve is really steepening, especially at the long end. Like you said, 4.4% right now on 10-year Treasury rates. Subsequently, our Chief Investment Office has raised their view on U.S. Treasuries up to 10 years to attractive for obvious reasons that we're talking about here. I think there's opportunity there. We're looking at the dollar weakening and what does that look like going forward. Obviously, there's a lot happening in the world of what the Fed has to pay attention to, including tariffs, which kind of made headlines again in February when the Supreme Court had ruled against the tariffs under the IEEPA Act, that they were unconstitutional. And now we've got, a few more months of them being at this 10% standard rate. Does that impact your thoughts on what we're seeing going forward?
It's still part of our macro thinking.
Yeah.
It's one of the reasons why inflation's high. It's one of the reasons why many goods are still expensive. We've seen the worst of the uncertainty and the shock there, but tariffs are not going away. Even though the Supreme Court's ruled the IEEPA reciprocal tariffs illegal, there will be refunds. I think the law is pretty clear on this, and the Supreme Court didn't need to specify this because the law is clear that companies need to be refunded in a timely manner, the importers of record, even with penalty interest. So there'll be refunds coming to importers, but the administration is moving quickly to replace those IEEPA tariffs with other tariffs that are basically in the 10% ballpark. We're expecting 10 to 15% tariffs on imports on average, as long as the Trump administration's around.
Right. Are there any specific sectors in your mind, David, that are either most vulnerable to that or might even benefit from that?
So the challenge has been to, these are goods imports, and often to retailers of goods and manufacturers of goods in the United States. It's been a challenge to the consumer in that sense, but not a daunting challenge. We've seen a lot of consumer spending resilience and expect to see that. A little bit of a benefit, at least in sentiment around U.S. manufacturing, but the real story at U.S. manufacturing and investment spending goes right back to data centers. That's where manufacturing, that's where CapEx is strong. There has been and continues to be a lot of sluggishness on other U.S. manufacturing. But while we're talking about challenges to the U.S. consumer, we saw something that was, imports of goods, 12% of the U.S. economy. We could debate who pays the tariffs, but a big part of the U.S. economy, and we weathered those tariff shocks very, very well, both profits, both the economy, consumer spending. So now if we look at oil prices, which have gone up and we think likely go up further in the short term, fuel costs, gasoline and other fuel costs, only 2.5% of GDP. So you tell me which is the bigger shock. I think we shouldn't overestimate the shock of higher oil prices and the ability of consumers to afford even $6 gasoline this spring and summer.
Right, and especially as you said, your expectations, DWS's expectations are that this conflict won't go on for long, but there is going to be, in the short term, some shocks, especially as we see CPI print come in again next month. We could see some of that reflected in that number, and it might just be a little bit of a spike in the short term until we can resolve the conflict and get the Strait of Hormuz opened again and get energy prices down.
That's right.
Yeah. Let me just finish with you, David, on the sector perspective. We kind of talked a little bit there, but with the risks that we are talking about in play, how are you investing in the market? How do you recommend clients, advisors be thinking about what we should be looking at for the next 6 to 12 months? Again, uncertainty is still one of the biggest words of the last 2 to 3 years, even maybe 5 years if you go back to COVID. But uncertainty is still in play. How do you play that?
We identify our preferences and things we want to lean away from, and some of our preferences remain preferences that we've had for a while. We're still overweight the financial sector, which is much more than banks, and our preference is for big banks and other financial services that are there. Steep curve, as you mentioned, a lot of profitability to be made by perhaps just buying 10-year treasuries amongst banks, which I think they will be part of funding this deficit. So we still like financials. Don't think we're going to have a recession. We think even the consumer is fairly resilient. Healthcare is still an area where the valuations are undemanding. The innovation has been finally coming through, particularly at biotech. We're excited about what AI can do in terms of cost savings, but also new therapy discovery, financials, healthcare. The demand for electricity in this country, we need more electricity, electric utilities. So when I look at how to play energy, I like energy infrastructure, pipelines, but electric utility companies are one of our favorite plays for just being defensive, getting income. There's growth there, and there's a lot of connectivity to the data center story as well. So those are some of our favorite spots. I am cautious on the consumer, both of those sectors. Do the stock picking, but we are tilting away from consumer discretionary and even staple spending. And I do think oil prices will come down over time. So I'm a little cautious on energy for a one-year view, but I do think oil prices go higher short term.
And like you said, in the sort of short term, we could see oil prices at the pump rise, where consumers are going to have to decide whether they put gas in the car or they go and do some shopping for those consumer discretionary goods. So it makes sense that you might be pulling back a little bit on the consumer discretionary sector, given the allocation of where the funds are going to go.
But lifestyle's sticky. There's still a decent savings rate and a lot of balance sheet wealth in the U.S. economy. We still have the one big beautiful bill, tax refunds in process right now. And I think with all the increased cost of living that we've experienced over the past handful of years, I don't mean to diminish it, and no one's going to like it, and it will put some pressure on the increment. But I think, $6 gasoline is not going to disrupt the U.S. consumer.
Especially if it's only for a few months.
Especially so.
Right, exactly.
Even if it's longer,
right,
it may be just something we get used to.
Interesting. Gosh, it is something. We've said that so many times over the last few years. We're getting used to these higher prices on various goods and services. Anyway, David, thank you very much.
Thanks for
Always
having me.
appreciate your insights.
Thank you.
Please come back soon. David Bianco from DWS. And for more information on anything coming out of our Chief Investment Office and our great partners like DWS, visit our Insights website at ubs.com/views. Plus, you can follow UBS on social media. We're on LinkedIn and Facebook, as well as Instagram. Follow the studio. Our channel there is at UBS Trending on Instagram, so take a look at that when you have a moment. And as always, if you have any questions about your portfolio, please speak with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day, and remember to keep your eyes on what's trending. We'll see you soon, everybody.